Okay. Up till now, we've kept it simple. We just said, to find the last component was the present value of the after-tax terminal value. You multiply the after-tax terminal value times 1 minus the tax rate and discount it back, and you got it. Well, what I didn't say is that it's a little more complicated in calculating that after-tax terminal value, and that's what we're going to cover right now. The after-tax terminal value is the terminal value minus any tax on your gain or loss. Okay, Uncle Sam is going to look to see if you had a gain or loss on the sale of that capital asset. The tax on the capital gain or loss is the gain or loss on that equipment multiplied by the marginal tax rate. This gain or loss is the terminal value minus your tax basis. Your tax basis is equal to your initial cost or price minus the accumulated depreciation. The accumulated depreciation is the sum of the depreciation claimed on your tax returns. The accumulated depreciation is simply you're going to take the depreciation in each period of the life of that investment and sum it up. In this particular case, the depreciation each year is constant of $5,333. So if we sum up those 5,333 for the 3 periods, you could either multiply that number by 3 or you can add them up, and it comes out to $16,000. So over the 3 years on that piece of equipment, we have claimed that there's been a $16,000 loss in value of that piece of equipment. Whether it's true or not true, that's what Uncle Sam's allowed us to claim. That's what we've claimed. For the tax basis, we get that by taking the cost minus the accumulated depreciation. The cost, if you recall, was $80,000. The accumulated depreciation we calculated on the previous slide was $16,000. Back to your accounting, this tax basis is what you would put as the asset value using cost basis accounting on your balance sheet, right? In this particular case, your tax basis or the value that is recognized by Uncle Sam is $64,000 in the end of 3 years when we sell this particular asset. The gain or loss is just simply taking the terminal value minus your tax basis. Now if you look on page 42, you can see that this farmer is expecting to sell this irrigation system in 3 years for $60,000. Paid $80,000 for it, 3 years expects that he can sell it for $60,000, but the tax basis is $64,000. So in this particular case, the difference between the terminal value and the tax basis, what he sold it for and what Uncle Sam recognizes as its value, the difference between that is actually negative. And because it's negative, then it's recognized as a loss. The next component, looking at the tax on that terminal, but in this case loss, and to calculate that we multiply this loss, or it could have been a gain, by the marginal tax rate. And so what we're going to do is put brackets around the gain or loss of the terminal value. And then we're going to multiply that by the marginal tax rate. We said the loss was $4,000, so we're going to multiply that by 2, which gives us a negative $800. What that means is it's going to reduce our taxes by $800 because it's negative. Negative means we're not paying that to Uncle Sam. Uncle Sam is giving that back to us. And that's because, if you think about it, it's simply because we had $20,000 of depreciation and Uncle Sam, based on his tax code, only allowed us to take $16,000. Or another way to look at that is we chose straight line depreciation instead of an accelerated depreciation, and thus we didn't depreciate it enough. And now it shows up as a loss. To find the after-tax terminal value then is simply we take the terminal value minus any tax adjustments, and sure enough it's terminal value minus the notation on the previous screen, and we sold it for $60,000, and we have a minus times a minus, which is a positive, and it says then that our terminal value after tax on this irrigation system is actually $60,800. $60,000 from whoever bought the irrigation system, and the $80,000 was because our taxes were reduced by $800 for that additional depreciation that we could claim that we didn't receive through the life of that irrigation system. Now, if we look at this from equation form, we know that the annual depreciation is 5,333, 80,000 divided by 15. The cost was given. The terminal value was given. And the marginal tax rate was given. So plugging that into this formula, you're plugging in some basic numbers into this equation and solving for it. This is, don't let this be hard for you. The only thing that you have to be semi-concerned about, of course, are these parentheses. You got to work from the inside of the parentheses out. Back to your basic algebra. If you're not doing that, just think back on the basic algebra. You're going to do the summation first, then you're going to subtract that, then you're going to subtract this, then you're going to multiply this, then you're going to subtract it from that. Work from the inside out, and that whole thing collapses into a very simple problem. The only number that you had to calculate was this straight line depreciation number, which is the sales price times the depreciable life. You know what I'm saying? It looks like a complicated equation, but it is not. And the only reason we're doing it is to make sure that we can adjust the depreciation so that ultimately the depreciation we claim for taxes is the true depreciation and not just what's in the tax code. Okay, so now we have our after-tax terminal value that we place at the end of the third year. That's the maturity of this investment, the last year. And then the next step is to calculate the net cash flows. And you can see that all we're doing is summing up these columns to get our net cash flow. So we can see that we pay out $80,000, and after taxes we earn $13,867 per year from the net revenues and after the tax adjustments. And then the last year we get the $13,867 plus we get the after-tax terminal value. We basically finished that step of laying out the cash flows.